Welcome back to Strongman Personal Finance. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And I had an interesting request from one of my subscribers. And they said, hey, Strongman, I want you to look at this stock that I've put 30% of my portfolio into. And I want you to rip it apart and give me the bear case. Well, you know what, buddy? I'm going to do just that. Bucko. So, today we have the stock, the stoink, called Golden Ocean GOGL. GOGL. Am I going all in? Am I going balls dizzy? No, I'm not. So let's read a little bit about GOGL. Before we do that, we can look at the recent price action over the last 5 years. So basically, the stock's been flat, and recently it had a spike. And that was roughly in November 2020, okay? And ever since then, it's had a massive freaking run. Now, this stock, from what I've noticed, pays a lot of dividends, okay? I don't like dividends. I will tell people over and over again. Dividends are hot freaking trash. Dividends do nothing. They're not compounding returns, okay? All a dividend is the company takes its accumulated profits, hopefully if they even have accumulated profits, and they distribute it to the shareholders. That tells me the company doesn't have a lot of use for its freaking money. So if a company pays a high dividend, that's not necessarily the return that you're going to get. Now, I'm on Robinhood Stock, which is notoriously trash, but before we get into the company, if we look, we can see the dividend yield is 13.3%. That's freaking high. Now, if you look at that, you'll say, well, I guess that means that I'm going to get a 13% return simply by owning this stock. It's common sense, strongman. No, it's not, you freaking clowns. Number one, you have to look at total return. Total return. Your total return is your dividends and share price appreciation. Now, I don't know if you guys knew this. This is a big secret in the investing community. When a company pays a dividend, let's say they pay a 2% dividend, that dividend comes from the retained earnings of the company, okay? It decreases the value of the shareholders' equity when that dividend is paid. So, for example, let's say the company pays a 2% dividend. Generally, the share price goes down by 2%. They pay a 2% dividend, the share price goes down by 2%. What does that freaking tell you, ladies and gentlemen? How much money did you make? None, okay? And on top of that, you gotta pay freaking taxes on the dividend. So a company could have 100% dividend yield, and that would still not mean it's a good company. You're not getting a 13% return because you can get 13% every freaking year, but then the share price goes down 15% per year. What's your total return there, ladies and gentlemen? It's actually negative 2%. Woo! Now let's read more about Goggle My Ogle, Gargle My Bargle. What are we? What are they? We are an international shipping company that owns and operates a fleet of dry bulk vessels comprising of Newcastle Max, Cape Size, Panamax, and Ultramax vessels. Our vessels transport a broad range of major and minor bulk commodities, including ores, coal, grains, and fertilizers. That's so beautiful. So as of March 18, 2021, they have 67 bulk vessels. I'm sure they have more. Now, recently, rates for dry bulk shipping have been going up because think about it as like a common sense perspective. When we locked down in 2020, there wasn't a lot of demand for a lot of stuff. Everything was shut down. You know, we don't need as much iron ore. We don't need as much this or that to produce stuff because consumption has gone way down because everybody's freaking locked down. And what happens is maybe some investors or people that, you know, want to invest or, you know, buy dry bulk vessels, they look at the short-term outlook of the economy and they're like, Should we really invest in more bulk vessels? Do we really need more right now when everybody's shut down and we don't know how long this pandemic's going to last? And what happened is everything started to clear up. People started to open up. Demand started to increase. Economy started to recover. And basically the supply of dry bulk vessels was too small for the sudden increase in demand of global economies. So what that means, and this is just a very simple summation. I'm not an expert in this freaking crap, but it's kind of common sense. What that means is if there's not as many dry bulk vessels and there's way more demand for all the things that these vessels are carrying, ores, coal, grain, fertilizers, the rates for all of these ships that people are going to pay are going to go up, okay? That's basically what happened. So if you look at GOGL my ogle, you can see that it's been basically flat for the last 3 or 4 years. And then you have this massive spike because freaking rates have increased very massively. Now, I've been doing a little bit of research. I didn't go super in-depth in this company. I don't like it. But if you look, you can actually track what's called the Baltic Dry Index, which is reported daily by the Baltic Exchange. And it provides a benchmark for the price of moving major raw materials by sea. So if you look at this index, you can see that it's actually pretty funny. For ever since 2008, it's been basically flat, okay? The prices have been very flat. I mean, you have some fluctuations, but you can see we've had some very, very crazy increases recently because of what I just talked about. Not enough vessels. Everybody needs the crap that they carry, so people are willing to pay more. It's supply and demand, okay? Now, what this means is, if you just think about it from an economic perspective, is if everybody's paying all these high rates to move all the stuff around the world, there's going to be massive investment into buying more vessels. Okay, there's going to be a lot of competition because what happens is everybody gathers around. They're like, "Oh my God, look how much we can charge for dry bulk stuff." And when that happens, people invest and the competition increases. And what that leads to is a company like GOGL eventually losing potentially market share and losing revenues. So, in the short term, I don't know where this stock is going to go. But my biggest issue with this, number one, is it's tied to commodities. I don't like freaking commodities. They're too volatile. They're too based on the global economy. They scare the crap out of me. Number two, it pays a high freaking dividend. Dividends are stupid, and sometimes they're not sustainable. You actually have to go look at the free cash flow and see if they can actually sustain that dividend. And, I don't know. Let's go look at the financial statements, okay? So, if you see, and you'll see in a second, this company wasn't doing that great before the whole pandemic started. Now, if you're timing this as like a trade, okay, maybe you can make some money. But for the love of God, do not put 30% of your freaking portfolio into one freaking stock, you crackhead. What kind of crack are you smoking, okay? If you want to YOLO, keep it to like 5%. Freaking degenerate moron. No, I'm just kidding. All right, look. So, here we go. First, we're going to look at the consolidated statements of operations. All right, this is the income statement. So, over the last 3 years, from 2018 to 2020, we've seen revenues fluctuate, but they've roughly, on average, probably been about $650 million. Okay, it's not a very big company. But from 2018 to 2020, we've had basically flat or decreasing revenues. That was because of the pandemic. Lockdowns, blah, 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 blah. I'm sure in 2021, their revenues have increased because of this temporary market condition where there is a massive demand for all these freaking tankers, dry bulk carriers. But how long will that last? Can you freaking time that? I don't think anybody can, okay? But basically, they weren't really doing that hot, okay? Revenue was flat. Let's see. Operating income, it was decreasing. It was $145 million in 2018, $100 million in 2019, negative $6 million in 2020. That was because of the pandemic, okay? And if you look at net income was also decreasing. So every freaking year, they were basically keeping revenues flat and becoming closer and closer and closer to losing money. And then 2020, of course, tipped the scales. Now, I'm sure they're doing amazing and everything's going swell right now, but this is such a cyclical stock and it's so tied to commodities and the global economy, and there's just so much. I would not risk a large amount of money in this. If you wanted to trade in this stock, I think you probably should have bought it a year ago, okay? I think I heard Michael Burry bought into this. Because if you think about it, it's like, okay, if you believe we were going to recover quickly from the pandemic, and you were kind of analyzing the, dry bulk carrier industry, and you said, wow, it seems like, everybody's pricing in that we're going to be locked down forever. And in reality, I think the economy is going to grow a lot faster, and there's going to be a potential shortage in dry bulk carriers, which is going to increase bulk carrier rates, which is going to increase the company's revenue and profitability. That's something you could have done maybe a year ago. I don't understand this industry that well, but to me, it's like kind of a common sense economics thing. Now, you're almost like buying in at the top after a lot of the gains and investment have been made. I could be totally wrong, but I'm not going to risk any money in this stock because I've said it 1,000 times. The freaking dividends, number one, I hate dividends. I think they're trash. You have to look at total return. And number two, it's way too cyclical, okay? So we go to the balance sheet. We look at, let's see, debt to equity ratio. Let's see, total liabilities, $1.4 billion. So it looks like their debt to equity ratio it's roughly hovering around 1. That's not horrible, but it increased a little bit from 2019 to 2021. And then we go down to the statement of cash flows. All right, this is another thing that I don't like. Net cash provided by operations. Down, down, down every freaking year. But because of this temporary situation where everybody needs bulk carriers and demand's hot, boom, now you're seeing freaking increases, okay? Temporary increases. But if you look over the past couple of years, it's been going down and down and down. Net cash provided by operating activities. Now, let's see what they did. Did they pay dividends? Let's see. So, well, first of all, let's look at debt. So if you look at financing activities, you can see when they're going into debt or paying off debt. So in 2018, it looks like they basically increased their debt by about $30 million. And then in 2019, it looks like they paid off a lot of debt. You can see that here. They have proceeds, that's money coming in from borrowing, of $398 million or $389 million. And then they paid off $621 million. And then in 2019, looks like, okay, or 2020, it looks like over the last 2 years, they were trying to pay off some debt, which is not really that bad, okay? Now, you can actually go and see the dividends down here, distributions to shareholders. This is a pretty scary trend for somebody that's buying this for dividends, okay? 2018, they paid $64 million in dividends. 2019, that dropped to $46 million. 2020, that dropped to $7 million, okay? I don't know what kind of dividend they're paying now, but you have to look at the historical record and see that a lot of margins, dividends, cash flows, they were all decreasing up until this one temporary situation. So my honest thoughts on this is that I think you're kind of playing with fire here, okay? I think you missed, if you're buying in now, I don't know when you bought in, you're missing the trade. You missed the trade, okay? Down here, okay, it's kind of like buying oil or investing in oil. It's like the economy shut down, oil stocks got crushed, oil's not going anywhere, and once the economy reopens, I think oil's going to move. It's basically the same thing as this frickin' company, okay? Now, if you had planned for that and thought about that in the late 2020s, you would have made a lot of money. Now, with all this crap going on, I wouldn't touch this stock. So overall, I think you're a freaking crackhead. But, you do you. I would highly recommend you don't put 30% of your money in this stock. And always remember, dividends are not real. They're part of your return. But just because a company has a high dividend means absolutely nothing. If that was the case, you would just buy the highest dividend paying company and supposedly make all the money. Make all your money. But what all that means is they're just paying money out because they have nothing to freaking do with it. Okay? So go look at the financials, go look at the trends. Understand that we're in a temporary situation and it could change at any time. And if that happens, your butt is going to be blown into 1,000 pieces, right? Well, that's it, everybody. Like, subscribe, tell your friends about me. I know I'm an expert on dry bulk shipping, yeah. And y'all have a wonderful night. Cheers!